Welcome everyone to a new update, and as you can see we are doing it in a different setting today. In today's update we are going to discuss everything you need to know about inflation. But before we're going to continue, make sure to subscribe beneath, like this YouTube update if you enjoy the content, and also check out our newsletter and premium membership in the description beneath if you want to join my personal trades. Now let's head towards the topic of today, which is inflation. During the pandemic, we had exceptional situations physically and economically. Luckily, we've passed the COVID-19 deadly health effects for now. However, the consequences of economic decisions in the pandemic are showing their real face these days. In the past quarter, economic growth has slowed. There's also a longer than expected increase in inflation, which will affect consumers and businesses' purchasing power. Demand will be further cooled by higher interest rates required to fight inflation. We have supply chain crisis, the Ukraine-Russia war in Europe, cash crisis in banks in China, political collapse in Sri Lanka, and many other big problems in the world. Besides everything, we have high inflation data all over the world, and inflation is a crucial one because it is affecting the cost of living. Today, we will discuss the current economic outlook, CPI data effect on the FOMC meeting, interest rate expectations, DXY and Euro USD, stock market, and an update on the cryptocurrency market. Before the pandemic, FOMC was implying expansionary monetary policy, which is a type of macroeconomic monetary policy that aims to increase the rate of economic expansion to stimulate the growth of a domestic economy. The main idea was to control the inflation rate by 2% and increase the growth rate in the US. To achieve that, they kept interest rates as low as possible to support economic growth. However, they lose control of the total money supply. Additionally, the pandemic hit the economy, so they keep increasing the money supply and even printing more to inject into the economy. The total money supply increased massively in recent years because of the expansionary monetary policy of the FOMC, triggering high inflation. That is the primary reason FOMC started quantitative tightening, a contractionary monetary policy tool applied by the central bank to decrease the amount of money supply in the economy. FOMC started to increase interest rates because of high inflation after the pandemic. However, they were late and rate hikes were not reflecting inflation data as expected, so they started to be a bit more aggressive at each FOMC meeting. The Consumer Price Index is a measure of inflation experienced by people in their daily lives. It's a measure related to the consumer's daily expenses. Inflation always has a wider reach, whereas CPI is based on the consumer product indices. OECD is an international organization with 38 member countries to stimulate economic progress and world trade. Yearly inflation in the OECD, as measured by the CPI, rose to 9.6% in May 2022 compared to 9.2% the month before, primarily due to the early policies to combat low inflation and lack of growth. Nevertheless, the situation got out of control and worsened by food and energy prices due to the Ukraine conflict. This represents the sharpest price increase since August 1988, and 10 OECD countries recorded double-digit inflation, including Turkey. The US inflation rate reached 8.6% in May. The latest projections by FOMC members indicate that the median forecast of the midpoint is going to be 3.4% at the end of the year. We will see more rate hikes in the following meetings, as the main goal of the Fed is to control inflation. The US CPI data came in at 9.1% for June, the highest rate in nearly 41 years. The CPI's reading for June was higher than May's rate of 8.6%, which led the Fed officials to shift to a faster pace of interest rate increases as inflation is rising way above the 2% goal. Inflation data is critical because it reflects people's life directly with increasing prices of goods and services. The first duty of the FOMC is to create price stability in the country, and inflation is the best data to measure it. The FOMC watches inflation data to determine whether to raise interest rates. If the FOMC thinks that inflation data is out of control to the upside, they will raise interest rates as a weapon to essentially cool down the economic growth and inflation with it. The main goal of the Fed is to decrease the inflation rate to an average of 2% in the long term, as this is deemed the most desirable for stable economic growth. The Federal Reserve's 75 pips rate hike in June to 1.5 to 1.75% was its largest since 1994 and higher than communicated beforehand by the Fed. Markets expect the FOMC to deliver another aggressive rate hike at its next meeting on July 26th and 27th. After June, CPI data published 9.1%, which was higher than expected. The market is pricing both 75 and 100 basis point rate hikes in the next meeting and has already accepted 75 basis points, even though 75 bips was quite recently considered to be extreme. However, it does not exclude the possibility of a 100 bips rate hike for now. It means that bearish sentiment is still in play for the crypto market because we will still have no slowing down signal from the FOMC regarding rate hikes. After the FOMC started to increase interest rates, the dollar gained value among all other currencies because a lot of capital flows to US government bonds as the risk-free rate increased. At the same time, other asset classes are more exposed to the worsening economy. This caused many to sell at this point. The overall uncertainty therefore causes many to close their positions in risky investments and causes them to move their funds to the safe US government bonds that actually give increasing yields while maintaining essentially zero risk. That situation showed its impact as a rise in the DXY index. Of course, the euro is the most affected currency in terms of DXY rise. The Euro-USD currency pair continued to fall on Tuesday, which began on Monday. 1 USD is now 1 euro. This shows how high the risks for the European economy are now due to the geopolitical conflict in Ukraine. It should also be noted that the aggressive monetary approach of the Federal Reserve is also of great importance on Euro-USD. Because when the FOMC starts to increase the interest rates, capital moves from risk-on assets and other currencies also. Investors choose to sell for dollars to benefit from high interest rates on safe US government bonds. Euro is especially affected a lot by this as its economy suffers a lot due to the war and because the European Central Bank is slow with its own rate hikes. As a result, the euro has fallen to its 20-year lows compared to the US dollar, and now we are seeing new sell pressures almost every day. The correlation between the S&P 500 and cryptocurrency has increased significantly in the last 2 years. After the beginning of 2021, US stocks and cryptocurrency started to increase together. One of the biggest reasons is that central banks started printing money and investing in the economy to offset the economic problems caused by COVID. However, that massive supply of cash created colossal inflation and central banks had to start rate hikes. Thus, cryptocurrencies began to enter bear market like stocks. Like in traditional markets, the cryptocurrency market also needs liquidity to survive. In the last 6 months, crypto market players learned the hard way. Because catastrophic events happened in the market like UST collapse due to lack of liquidity followed by Luna, the bear market pattern continued with VC and CeFi destruction, for example 3AC, Celsius and Voyager bankruptcies. It is all related to global economic conditions and the lack of regulations for the cryptocurrency markets. In summary, we can easily say that the cryptocurrency market is highly correlated with the traditional markets. Economically, the expectations of a recession are getting higher because after the pandemic started, money supply was increased massively by central banks, which caused inflation and central banks failed to control it. Now we have both high inflation and high interest rates. There are also more risks like another pandemic, supply chain problems, a banking crisis possibly in China, and more bottomless food and energy shortages because of the Russia-Ukraine war near the EU. The war between central banks and inflation is not going well considering economic activity and consumer purchasing power. It is likely that the FOMC will continue to increase interest rates aggressively because inflation continues to rise. Rate hikes will probably damage risk-on assets because liquidity will move from risk-on assets to risk-free investments. As a result, we can easily say that monetary policies are still in favor of risk-free assets like US government bonds, thanks to the central banks. As a result of the QT and rate hikes, demand for USD increased massively. That situation might signal a global recession in the long run because of supply chain disruptions, a war in Ukraine, elevated inflation and higher interest rates. USD is gaining value against all currencies as a risk of investment. As a result of the overall economic situation, higher rates are also designed to slow down economic growth, which further puts this as a risk. It is a possibility that people are pricing in the global recession. A strong USD means less capital for risky assets like stocks and cryptocurrencies. The primary reason for the collapse of Luna, Celsius, Voyager and 3AC mainly was mismanagement, and illiquid market conditions didn't help either. Institutions in the crypto market are not regulated. The downfall of the cryptocurrency market was swift and painful. Macroeconomic conjuncture is still bearish, so the cryptocurrency market is also bearish as most assets start to correlate in times of economic uncertainty or fear. Everybody wants to hold USD in their portfolio because of the fear of recession and increasing interest rates. The next FOMC meeting is on 26 and 27 July. Market mostly waiting for 75 pips rate hike from the meeting, on the other hand also pricing in 100 basis points. We should expect a bearish trend for risk-on assets like stock and crypto if a 100 basis point rate hike is announced. However, sentiment should be the same as of now if FOMC declares a 75 basis point rate hike decision. In contrast, most people are expecting the same scenario, so there is a possibility that we can see a bullish reaction even after a 100 basis point rate hike. Finally, we might be in peak inflation at this point, as markets have been seeing a heavy correction already and commodities have been starting to correct since. Next to that, job reports are coming in as an important note for the Fed as well, through which an assumption can be done or made that the Fed can keep up with QT in the long run and they need to do QE to improve the economic situation, maybe even in 2023 already. Thanks for watching for this update. I hope you have enjoyed the new setup, and for the coming weeks we are going to integrate way more videos based on trading and investing, but also fundamental content to make you a better trader and investor. If you have enjoyed this update, make sure to subscribe beneath, like this YouTube update, and check me out in the live streams on Monday, Wednesday and Friday, 10 AM Central European Time. Don't do stupid shit, and I'll see you again tomorrow.